Gold gains the most in a week today as the dollar's rally takes a breather, reversing what's been a year-long trend. And have investors abandoned the euro? Maybe not, so says Axel Merk, president, manager at Merk Investments and portfolio manager of the Merk Hard Currency Fund. He continues to be bullish on gold and says that writing off the euro may be premature. He joins us now from Mountain View, California with some insight. Welcome to you, Axel. So according to your last research note, you see signs of greater instability in the euro region to come. Let's start there because this is the ripple effect we're all so worried about.
Well, the greater instability is a worldwide instability that's going to come, and we're just seeing a little warning sign there in Southern Europe. But we'd have to look anywhere in the Western world, and the budget deficits are not contained, be that in California or U.S. budget deficits in general. Right now, the focus is on Southern Europe. But to make the greater point, I don't think that there's necessarily a conclusion that the Eurozone at large is at risk. I don't see the connection there. Obviously, some people are worried about the contagion. But the one thing that people don't realize is that it's healthy that the markets are finally forcing these countries to get their act together. The policymakers are incapable of reining in the deficit, so it's good that the markets are pushing up the yields, increasing the cost of borrowing, forcing these countries to take action.
But the problem and the concern is that these countries don't have the means to, as you put it, get their act together. I mean, what is the outcome going to be here? How can they do that?
Well, these countries don't just disappear like corporations do, so there's going to be some long-term suffering. You mentioned gold in the context. Think about in some terms, and that may offend some people, that the Eurozone is like a gold standard, and obviously it is not, but the gold standard doesn't allow people to print money. Similarly, a country like Spain or Greece or Portugal cannot just print their own money. And so they have to go through the suffering. They have to find ways to get through this. And yes, default is one of the options. It's an unlikely option. The European Union or the IMF is likely going to come and bail them out ultimately. But still, for the time being, in the U.S., if you contrast that with the currency, in the U.S., when you have a problem, you just print the money. You have a Treasury Secretary in the U.S. that can put $1 trillion into the banking system. You don't have that in the Eurozone. So our view is that the Eurozone is going to have lousy economic growth, but on the backdrop of a very strong currency. You only need to have economic growth to support a currency when you finance your deficits from abroad, when you have a current account deficits. So the U.S. is dependent on growth, but the Eurozone is not. The countries that devalued during the Great Depression, including the U.S., recovered faster from the Great Depression. So if you don't do that, then you're going to end up with less economic growth, but a much stronger currency.
So let me try and pin you down here. You think we should bring back the gold standard for central banks?
Well, it's unrealistic. What I want isn't really here on the table here. Over the last 100 years, we have moved further and further away from the gold standards. We're living in an increasingly unstable world, and there's no such thing anymore as safe assets, and we've been encouraging investors to take a diversified approach to something as mundane as cash. Central banks do it, and individuals should look at that as well. But the Eurozone provides a mechanism that's very painful. Now, some people are saying there is no management in Europe because there's no single Treasury Secretary. They don't have to act together, and that's all correct. But that doesn't mean it's the end of the Eurozone. That means that these committees will drag on for a while, and in the process, they'll spend less. Think about California. They have furlough days. They don't resolve the issues, but in the meantime, they cut spending, and that's ultimately healthy.
Speaking of the euro, the currency itself, a lot of speculation. One of our earlier guests this afternoon said, hey, there's a real chance in years to come that the euro could be no more. Yet you see the euro as an anchor for stability. Why is that?
Well, first of all, the European Central Bank's policies are far more robust than that of the Federal Reserve. The Federal Reserve has bloated its balance sheet with mortgage-backed securities with durations in years. They'll struggle to find an exit strategy. We'll hear more later on this week. In the Eurozone, the central bank policies is a far more robust one. They can wind up their programs. They can mop up the liquidity far easier. Now, some people have an issue in the Eurozone because of the Stability Pact that it's very difficult to enforce, and that's true. But ultimately, what we need in the Eurozone is we need to have the market forces play out. And we finally see that the yield spreads widening in Europe is a sign that the market is working, punishing the imprudent ones. And that is why Europe will be fine. Europe will, of course, they'll have some issues, but the Eurozone in general is going to be far more robust compared to the U.S., where we'll just print the money and we have deficits no matter how far we see. And there's absolutely no mechanism in sight to try to rein those in. And so and the U.S. dollar is far more vulnerable because of the current account deficit. And in a world where everybody's trying to inflate them way out of the problems, the Eurozone may lag in growth, but it may do so on a much stronger currency.
We'll have to leave it there for time considerations. Axel Merk, the president portfolio manager with Merk Investments. Thanks so much for your time.